What if the trend isn't clear? You've learned the basics of price movement in trends, but when the market moves sideways or stalls, it gets trickier. Let's explore how patterns like triangles, flags, and rectangles can help you navigate these uncertain phases. Consolidation occurs when the market pauses, moving sideways within a range. It's a period of indecision where traders accumulate or distribute positions before the next significant move. There are several common consolidation patterns that traders watch closely. These patterns don't last forever because sooner or later, price breaks out. Let's break down 3 key patterns. A common consolidation pattern is the triangle. As price moves sideways, it forms lower highs, each peak is smaller than the last, and higher lows, each dip is higher than the one before. This creates a tightening range, coiling, a signal that the market is building pressure before a breakout. An ascending triangle is a bullish pattern that usually appears during an uptrend. It forms when the price keeps making higher lows, but struggles to break through a horizontal resistance level. The price typically bounces between a flat upper resistance line, marked as number 1, and a rising lower support line, marked as number 2. An ascending triangle shows that buyers are becoming more aggressive over time. When the price finally breaks above that resistance, especially with strong volume, it can signal that the uptrend is ready to continue. Traders may enter a buy trade at that breakout point. To manage risk, they often place a stop loss just below the most recent low inside the triangle. For the target, they measure the height of the triangle and project it upward from the breakout area to estimate how far the price might go. A descending triangle is a bearish chart pattern that often forms during a downtrend and suggests that sellers are gaining strength. It's characterized by a flat support line and a series of lower highs. Traders usually watch for a breakdown below the support level to confirm the pattern. To trade a descending triangle, traders often wait for a breakout below support and enter short positions. A stop loss is placed above the last lower high, and the target is set by projecting the triangle's height downward. A symmetrical triangle forms when the price moves between converging support and resistance lines, creating a series of lower highs and higher lows. This pattern shows indecision. Neither buyers nor sellers are in control. It can break out in either direction. Traders typically wait for a decisive breakout above or below the triangle with increased volume before acting. A breakout to the upside may signal the start of a new uptrend, while a break below suggests continued weakness. Knowledge check. What does each triangle pattern signal? Match the triangle pattern to what it typically signals about market behavior and potential breakout direction. This pattern indicates a temporary pause in the market, often leading to a breakout in the direction of the initial trend. There are bullish and bearish flag patterns. A bullish flag follows a strong uptrend with a slight pullback, while a bearish flag forms after a downtrend with a brief upward consolidation. Both suggest that the market is likely to continue in the direction of the preceding trend upon breakout. To trade this pattern, traders usually wait for a breakout, then enter in that direction. They place stop-loss orders just outside the flag's range and use the height of the flagpole to estimate how far the price might go. You've identified a bullish flag forming after a strong upward price move. The price is approaching the upper boundary of the flag. What's a common strategy traders might use at this point?
Yes, you're right.
Nice work! A breakout above a bullish flag is a continuation signal. Traders often go long and project the height of the flagpole for their profit target. A rectangle pattern forms when an asset's price moves within a defined range, bouncing between a horizontal support level and a horizontal resistance level. This creates a visual box on the chart, signaling a pause in the current trend as buyers and sellers remain in relative balance. There are 2 types of rectangle patterns, bullish and bearish. A bullish rectangle occurs during an uptrend and usually results in a breakout to the upside, while a bearish rectangle develops in a downtrend and often breaks lower. Traders spot rectangles when price bounces at least twice between clear support and resistance levels. This signals consolidation. A breakout beyond the range often resumes the prior trend, and traders enter once the price closes outside the box with strong momentum. A rectangle pattern forms when price trends sharply without any clear support or resistance, making it unpredictable and hard to trade.
No, the correct answer is false.
A rectangle pattern forms when price consolidates between horizontal support and resistance, bouncing within a clear range. This structure offers traders defined levels to watch for potential breakouts and continuation in the direction of the previous trend. You've just learned how to identify and trade triangles, flags, and rectangles. Next up, we'll dive into continuation and reversal patterns, key tools for spotting turning points and confirming new trends. Time to explore continuation patterns. In this lesson, you'll explore continuation patterns, formations that suggest the current trend is likely to resume. We'll cover rising, falling wedges, and bullish, bearish rectangles, and show how traders use them to plan breakout entries. Continuation patterns form during pauses in the trend. They show temporary consolidation before price breaks out in the direction of the original move. Traders watch these patterns to prepare for re-entry. Let's start with the rising wedge. This pattern forms in an uptrend when the price makes higher highs and higher lows, but within a narrowing range. This means momentum is weakening. The moves up are getting smaller and slower, which often leads to a downward breakout. The rising wedge slopes upward against the dominant trend. When price breaks below the lower support line, it often signals a continuation of the broader downtrend. Traders usually enter short positions after the breakout and place stop-loss orders just above the last swing high inside the wedge. Your profit target would be the length of the wedge, measured from the breakout point to the top of the wedge. Now, let's look at the falling wedge. It forms during a downtrend with lower highs and lower lows, but the range narrows. This pattern often breaks upward, continuing the bullish move. The falling wedge slopes downward, but a breakout above its upper resistance line often signals a continuation of the uptrend. Traders enter long at the breakout, place stop losses below the recent low, and set targets by adding the wedge's height to the breakout point. Time for a quick quiz! ExxonMobil's stock just broke out above a falling wedge after a pullback during an uptrend. As a trader, what is the most strategic action to consider?
Yes, you're right.
Exactly. Entering a long position on the breakout with a target based on the wedge's height is a common continuation strategy. A rectangle pattern represents a period of consolidation where the price moves sideways, bounded by a horizontal resistance level on top and a horizontal support level below. It looks like a box or rectangle on the chart. Bullish rectangles form during uptrends, where price bounces between horizontal support and resistance. The price consolidates before continuing higher. The breakout from a bullish rectangle usually happens to the upside. Traders enter long trades after a strong breakout above resistance. To manage risk, traders place stop losses below the support level and set targets equal to the rectangle's height added to the breakout point. Bearish rectangles appear during downtrends. Price moves sideways between horizontal resistance and support, forming a box before continuing downward. When price breaks below the rectangle's support, it confirms the continuation of the downtrend. Traders may enter short positions on the breakout. Stop losses are placed just above the resistance zone, and profit targets are set by projecting the rectangle's height down from the breakout. You spot this pattern in a downtrend. After multiple bounces between resistance and support, the price finally breaks below the rectangle with strong momentum. You decide to enter a short trade right after the breakout and set your target equal to the rectangle's height. Is it a smart move?
Yes, you're right.
A bearish rectangle signals a pause in a downtrend. A breakout below support confirms the pattern. Traders often short at the break and target a drop equal to the rectangle's height. Great job! Recognizing continuation patterns helps you avoid false reversals and stay aligned with the trend. Whether it's a wedge or a rectangle, knowing what comes next can sharpen your entries. Knowledge check. Match the pattern with the trend direction. Which breakout direction matches each pattern setup? Excellent. You've learned how to identify and trade rising, falling wedges, and rectangles. These continuation patterns help you stay with the trend. Next, we'll shift gears and explore reversal patterns, key signals that a trend might be ending and a new direction could be starting. It's time to spot reversals. In this lesson, you'll learn how to identify key reversal patterns like the double top, double bottom, and head and shoulders. These patterns often mark turning points in trends, helping traders avoid getting caught on the wrong side. A reversal pattern signals that a trend is losing strength and may be preparing to change direction. Recognizing these patterns early helps you exit bad trades or catch the beginning of a new move. A head and shoulders pattern signals a potential trend reversal. It features a left shoulder, a head, and a right shoulder, followed by a break below the neckline. This pattern shows weakening buyer strength. Price makes a high, then a higher high, but fails to push higher a third time. Buyers lose momentum. When price breaks below the neckline, support between the two lows, it confirms a possible reversal from an uptrend to a downtrend. Let's check your understanding. You're analyzing JP Morgan stock and notice a potential head and shoulders pattern. The right shoulder has just completed, and the price has broken below the neckline. What is the most strategic action to consider now?
Yes, you're right.
Well spotted. A confirmed neckline break often indicates that the uptrend has reversed. Traders typically enter short at this point. Let's look at double top and bottom patterns. A double top signals a bearish reversal after two peaks. A double bottom suggests a bullish reversal after two dips. Breakout through the neckline confirms the setup. It signals buyer weakness, confirmed when price breaks below the neckline. A double bottom forms after a downtrend, when price tests the same low twice without breaking lower, signaling weakening seller control. A breakout above the neckline confirms a reversal. For a double bottom, traders wait for a break above the neckline to enter a long trade, placing a stop loss below the second bottom and targeting a move equal to the pattern's height. This helps manage risk and confirm the reversal before committing. Knowledge check. Match pattern with trader's decision. Which actions match each pattern setup? Drag the right decision to the pattern it supports. Not every pattern works out perfectly. False breakouts can happen. That's why traders always set stop losses and manage risk, especially near major support-resistance zones. Time for a quick quiz. You've been tracking McDonald's stock. After two peaks at similar levels and a break below the neckline, you spot a potential double top pattern. The price is now below the neckline and momentum is weakening. Based on this setup, what is the most reasonable action?
Yes, you're right.
Well done. A confirmed double top suggests the uptrend is weakening, and a break below the neckline signals a possible reversal. Traders often consider short positions here. Excellent. You've just learned how to spot and trade powerful reversal patterns. These signals can help you avoid chasing trends that are losing steam and even catch early entries into new ones. Now get ready to apply everything you've learned.